All right, folks, most of our attendees have arrived, so I'm going to get started. My name is Neil Bala. You see my picture up here to the right. And I am a partner at Financial Attunement, which is a company that buys and manages multifamily products. So welcome to Multifamily Fundamentals. My partner, John Mark Landau, and I have spent weeks putting this presentation together. So this is the first time that the entire presentation is being presented in this format. So I'm very excited about that. Keep in mind that you can ask questions. You can type them into the window, and then on my side, there's a bar off to the right that has a little question sign, so it starts to flash. So I will cover all of your questions at the end of the presentation, but if I see the bar flashing, I will certainly interrupt my presentation and pick out a question and answer you. All right, so let's get started. Let's start with a disclaimer. So we are not investment advisors, and this is educational webinar only. And keep in mind that all investments involve different degrees of risk, and you need to be aware of your risk tolerance level. Also keep in mind that you should not be accepting just our recommendation about any area, whether it's single family or multifamily or indeed real estate. So make sure that you are doing your own research. So here's our goal for today. My first goal is I'm going to start with the big why and the big how. And this is really going to be about why people need to be investing in real estate. So I don't want to give too much of this away. I'm going to introduce you to the $2 trillion, that's right, $2,000 billion US multifamily market. It's the biggest market that most people haven't heard of or don't think about. We're going to talk about the incredible market trends that are driving, absolutely incredibly driving multifamily growth in the last few years. We're going to explain how groups of investors buy multifamily properties together. And we're going to discuss the top reasons to invest in multifamily, because it's not just the market trends that are driving multifamily. The market trends are specific to today, but there's a lot of reasons, and there's 10 reasons. I've actually put 6 of them in this presentation that exist at all times that are good reasons to invest in multifamily. So we're going to discuss those. We're also going to go through today, and this is really incredible learning for those of you who don't know about multifamily. We're going to go through the life cycle, the entire life cycle of a multifamily project. And then we're going to do a quick recap at the end. And also we're going to tell you about some of the multifamily properties that we are currently syndicating or buying. All right, so let's start with the big why and the how. The first big why is, why can you not afford to only invest in stocks and bonds, with the key word being only? A lot of people are investing in stocks and bonds. Some of them invest directly and some of them invest through retirement funds like IRAs or 401ks. But I'm going to tell you why you have to diversify beyond that, and not just diversify, why you have to seek higher yields. Now, I know some of you are not really thinking about, well, I don't want to invest in multifamily. I want to buy multifamily and bring other investors together. Keep in mind that this presentation applies to you as well, because the thought process of why you want to be in multifamily remains the same, regardless of whether you want to be a passive investor or whether you want to be somebody that's buying multifamilies and flipping them, or buying multifamilies and arranging groups of investors. The thinking remains the same. All right, so this is interesting. Why are stock experts promoting real estate? So I'll tell you about this one. I went to a real estate seminar, and there was this stock expert, and he's somebody that had been promoting stocks for a long time, and so went into his presentation, and to my absolute surprise, what he was pitching was multifamily. And his rationale was very simple. He said, well, stocks have been going up since 2009, so they're, it's 2015, and they're at peak, so they're now either going to decline or they're going to float around where they are. And since he told me that, we've actually seen a mini decline. We've seen about a 5-6% decline already. But I think his point was, well, I don't like them even if they're staying in the same place. They have to go up, and I'm not sure if they're going to go up. Real estate still has a long way to go, especially because it hasn't fully recovered from the recession. But multifamily has an incredibly long runway in front of it. And so he was promoting real estate, and that really made me feel fantastic. And then once we discuss the 3 whys, we're going to discuss the how. Most of our presentation is really right here. How can you invest in real estate passively without managing, without rehabbing, without clipping? Now, even if you're the manager that's leading a multifamily purchase, you're still not doing any rehab or flipping, because all of that is being done by professional property managers. So let's get started on why, and we're going to discuss the first 3 whys here. So why can you not afford to only invest in stocks? Why must you seek higher yields? And why are stock experts promoting real estate? Well, the answer is really staring us in the face, and that is that America's Social Security and retirement system was designed for a different time, a different reality. And there are 3 massive reasons for this. Reason number 1, life expectancy. So in the year 1900, the average life expectancy was 49 years. So your great-grandfather pretty much worked until the day he died. In 1960, the expectancy rose to 69 years. So your grandfather, your grandmother, their retirement had to last them a few years. Today, it's 79 years and rising fast. It's already in the 80s for women. So now your retirement has to last decades. But when they designed the Social Security system in the early 60s, nobody knew about this 79 years and rising. So the Social Security system really is not designed for the life expectancy today. Second, healthcare costs are rising way faster than inflation. And how much faster than inflation? This much faster. So, and keep in mind that most healthcare expenses come in the final 1 to 2 decades of life. I've heard numbers that range from 70% to 80% of all healthcare costs being in the last 2 decades of life. So as you're getting older, this number really is staring you in the face, because a lot of the inflation numbers don't keep this in mind. And this is my favorite. And this is where really anyone amongst you that is in the stock market should pay careful attention. So, I have a quick question, so I'm going to interrupt for a second. Will the slides be available to attendees after the webinar? Yes, absolutely. You will get both slides as well as the video copy of this webinar by tomorrow. So no need to take slides, David. No need to take notes, I'm sorry. All right, let me put that back there. All right, so here is why stock market returns are not true. The reason for that is when you hear about stock market returns, they don't usually adjust them for inflation. And if you adjust them for inflation, they're far too low to get ahead. Here are amazing numbers that I'm pretty sure most people haven't seen. What is the annual growth over the last 14 years in the stock market adjusted for inflation? I didn't put 2015 in there because it's going to look really bad. But here it is, 2001 January to December 31st, 2014. Now I adjust for inflation and I include dividends. My returns, or true CAGR, or compound adjusted gross returns, are just 3% a year. Remember, this is adjusted for inflation. So if you put $1 in on Jan 1st, 2001, you now just have $1.151. Now, how are you going to save enough money for retirement when it's growing at 3%? Keep that in mind. So what do you do to get ahead? Well, what you need to do is, firstly, you need to understand the magic of compounding, which is, you have some money, you make a certain amount of return, and then you leave that money there. You don't pull it out. You leave it there and allow it to compound and grow again. And then you need to do the second part, which is add investments with potentially higher yields to your portfolio. And let me show you just how much of a difference this makes. It makes an absolutely enormous amount of difference. So here's my example. If you invest $100 for 30 years at 3 different levels of return, what do you end up with at the end of 30 years? Okay, so if you invest $100 at 2%, well, after 30 years, that $100 has become $182, I'm sorry. After at 10% return, now you've got a much nicer chunk. It's gone from about $100 to about $2,000. So that's a reasonable return. Now watch this. If you had 18% returns, that $100 on the left has now become $21,270. This is why, and this is very counterintuitive, because most people don't think that 2, 10, 18, they think that it will be a bar that looks kind of like this. They wouldn't think that it's going to go up like this, because compounding is exponential. It's like a hockey stick curve upwards. And this is why you absolutely have to find higher yield returns if you want to retire in a reasonable fashion. Now let me flip this around for you. So now I'm going to look at it from the end goal in mind. So let's say you want to have $15,000 a month income in passive income 20 years from today. Well, how much do you need to save each month at those 3 same levels of yields? So if you have a 2% yield or 2% return, amazingly, you need to save $30,000 a month, which adds up to about $9 million at the end of those 20 years. And at a 2% return, you'll be making about $180,000 a year, which is $15,000 a month. So obviously, somebody who's saving $30,000 a month is actually going to want more than $15,000 a month 20 years from now, adjusted for inflation. So 2% just doesn't work. 10% works a little bit better, because now you have to save $2,370 a month, and you will end up with that $15,000 a month in passive income 20 years from now. Again, that's before inflation adjustment. But if you start looking at higher yields at 18%, you're only looking at $433 a month in savings. That's right. This number is 1/70th of this number. Once again, not very intuitive, because this is only going up from 2 to 18, but this number is going up 70x. So this is a reasonable number. For me, it seems like I could save $400 a month, but I'm not sure I can save $2,370 or $30,000. So keep the end goal in mind when you're looking at retirement. So with that in mind, let's now learn about what financial attunement does. So we're 2 guys, Neil, me, and John Mark, who isn't here today because he's teaching another webinar. And we're passionate about having your assets work for you. And we're passionate about fine-tuning your thinking about capital, returns, and investing. That's what I was doing, hence our name, Financial Attunement. So we buy and manage multifamily complexes nationwide. We tend to be biased towards large multifamily, though keep in mind there's lots of great deals in multifamily complexes of a 5 to 50 unit size. It's not for us, but there are lots of great deals there. And a number of people that start in multifamily tend to start in that range. We currently own properties in California, in Texas, and Oklahoma City, and soon Illinois. We should have a property closing in Illinois in less than 30 days. And here's our competency. We understand how to find assets, how to select them, and how to manage them. And through this presentation, we'll explain how the process of how we do that. Between him and I, we've got decades of real estate experience. As you can see, he's got a little more white in his hair than I do. So a good chunk of that comes from John Mark. Though I've had my challenges and my wins in various states that I've invested in. So here it is, an intro to multifamily. Let's learn all of the basics of multifamily all in one place. So here's the first one. What does the term multifamily really mean? Well, most people would say it means more than 1 unit. Multi equals 2. Well, not quite. From a perspective of loans and the way that units are structured, multifamily generally means 5 or more units. And it reaches true economies of scale at 150 units, though even at 5 units, you get some economies of scale over a single family home. Now, why 5? Well, that's because all of the lenders that are giving us loans, they treat 1 to 4 units as if it's a single family. So if you're buying a quadplex, you're really buying a large single family. And I'll tell you in the next few slides why they look at it that way and why is that important. So you need to get a residential loan, and you need to look at your credit history if you're looking at 1 to 4. So how are multifamily properties valued, right? In the last slide, we learned that lenders treat them a different way. Well, because lenders are looking at the operating income, the net operating income, also called NOI, of the property, they do not look at comparables. So here's the last thing that will ever happen in multifamily. There's 2 multifamily buildings. They're next to each other. Let's say they're 10 plexes. They're next to each other. They were built in the same year. They're exactly the same size. They're in exactly the same condition. Well, you would think that they would both be worth the same. Well, no. One of them actually could be worth twice as much as the other. That's because it's better managed, the rents are higher, the delinquency is lower, the maintenance costs have been kept down, and as a result of that, its net operating income is twice as high. And this is the true magic of multifamily. If there's nothing else you remember from this presentation, I want you to remember this part. Multifamily is incredibly different from single family in the way that it's valued. Here's an example. In a 200-unit complex, if the management successfully raises rents by just $25 per unit, instantly and immediately, the value of that property goes up by $750,000. Instantly and immediately. And how does that work? Well, you've got 200 units. You raise rents by 25 bucks a month over a year. You multiply that number, and then you use what is known as a cap rate. Now, we're not going to go into detail on what a cap rate is, but this is how multifamily complexes are valued. If you're in the Bay Area, in the San Francisco Bay Area, this number, it probably drops to 4. So this number goes up from 750,000 to 1.5 million. But for the rest of the United States, an 8 cap rate is a reasonable number to look at. So by doing this calculation, anyone who shows up to buy that property tomorrow, if you've successfully raised all the rents by $25, they'll be happily willing to pay you $750,000 more. That's the magic of multifamily, and that's why there is so much money in multifamilies. You cannot imagine doing this with a single family. It will never work. So who manages a multifamily property? I mean, I can manage a single family on my own, and I can gather rents. But what happens with a multifamily property? Well, you're not the landlord. Multifamilies are usually run by professional property managers, on-site leasing agents, and full-time maintenance staff. Now, none of these things are true if it's a 10-unit or 20-unit, but by the time, especially if it's in California, by the time you are getting to 15, 20 units, you should be at least able to afford one person. And that one person may be part-time, maybe full-time, maybe there's somebody that's living in there and you're cutting them a discount on their rent, but they're the ones managing it. Now, the kind of properties that we like to buy are always over 150 units, and they always have a full-time property manager, one leasing agent, and 2 maintenance staff. Now, the properties over 200 units, it usually has 6 full-time staff. And these people live, and sometimes they live there, but they work at the property. They are not contractors. Now, neither investors nor the managers of multifamilies tend to be involved in tenants and toilets. Essentially, what that means is, even if we are the asset managers and we're managing the assets, we're really not involved in the day-to-day running of the property. The property management company does that. So how do we manage it? We're not running it day-to-day. How do we make sure that it has the right operating income? Well, multifamily is run based on metrics. So there are metrics around sales and about occupancy. There are metrics around cost and maintenance pieces. And then there are metrics around profit. And those metrics are based on the area, based on the number of units, based on comparables in the marketplace. And because everyone seems to be using the same top 3 or 4 property management software, those metrics are available to us. So we can look at our area and say, my area should have 96% occupancy. My area should have 1% delinquency. My area should have maintenance around 6%, because that's what all of the other units around me have. And by doing that, we go back to our property managers and say, you're doing a great job of running this property, pat on the back, or, well, you're not doing such a good job of running the property. You need to do better, or I'm going to move you out and hire somebody else. So a very different world from how single-family landlords deal with their clients. So I think we talked about this. Loans are based on property's operating income, not your income and credit. What's interesting is, let's say you have really, really bad credit, right? Well, you're not going to be able to buy a single-family home. Even if you want to rent it out, they're not going to let you buy it because your credit is not good. Guess what? It has no bearing on you buying a 5-unit. So my partner, John Mark, started in 1982, and he tried to buy a single-family home, but he couldn't because his income level was too low. So guess what he did? He bought a 6-plex instead. Isn't that funny? He was able to qualify for a 6-plex, but not for a single family, because the 6-plex had enough rental income coming in, he still lives in one of those 6 plexes in San Francisco. So for those of you out there that are thinking, my credit is not good enough for me to get into real estate, multifamily is easier. They're not looking at your credit. All they care about is the property's operating income. So one of the nice things about being an investor in multifamily is lenders scrutinize the property in great detail. When you buy a single family and you're saying to a lender, oh, I'm going to rent it out, they're not going to ask you for a rent roll, but it is typical for multifamily for the lender to actually ask you for 2 and sometimes 3 years of rent roll, 3 years of maintenance, because they want to know, is this property truly worth the amount of money that this person is paying for it? Because the bank is giving you a loan, so they want to be very careful with it. Now, they loan all the way up to 80%, sometimes even beyond that, but they really want to scrutinize the property. Well, why is this good news for the investors? Well, the bank is being much more careful than they tend to be for single family. We've already been through one catastrophic depression in real estate because the banks didn't do their job right and didn't lend to the right people. None of that stuff happens in multifamily because the banks are very focused on operating income. They do not lend on potential. Let me take a question here. Cannot see your screen. This is from Michael DeVries. Well, it seems like my screen is shared out, Michael. Is there anyone else that cannot see my screen? If there's someone else, please type it out so that I know that other people can't see my screen. Good. Looks like everyone can. Sorry, Michael, you'll have to look at the video of the webinar, which you should get. Thank you, Ian. You should get the video in, I would say, 2 hours or so. So sorry about that. I would fiddle with it on your side because it looks like other people can. Yep, a lot of people have responded saying they can see my screen. Perfect. All right, let's keep going. So what's the focus like for people like us that buy multifamily? What are we doing, right? So we're buying a good multifamily in a good place. What are we doing? Well, the focus is on improving the cash flow. So the first thing that we want to do is we want to raise the cash flow. We want to raise the income, and we do it in multiple different ways. So if the property is, if rents are under market, that's the first thing we go in and do. We raise the rents because a lot of owners are afraid of raising rents to market. This is very typical. We see it all the time, and we see it amongst people that are rich. The property in Chicago that we're buying is owned by somebody that has a net worth of $40 million, but he's still afraid of charging market rent. And so over time, their net operating income reduces below what the market should be, what it should be, and that gives us a window of opportunity to come in and start raising rents. The other thing is delinquency. So if they have delinquency that's higher than normal, they probably have a terrible property management team. And it's really our job at that point of time to help the property manager or push the property manager to raise the income. And when we do that, remember that whole $750,000 example I gave you? Well, when we raise rents and when we reduce maintenance costs, we automatically and immediately raise the value of the property. We don't have to wait for some appreciation to happen 2 years, 5 years, or 10 years down the line. By simply raising rents and raising operating income, we raise the value of the property. It's kind of like magic, yes. So there's always a choice of balance between cash flow and market appreciation when we look for the properties. Let me give you an example. If I was buying a property that was completely stable, right? So let's say 94% occupied, everyone's paying rent. When I buy this property, I'm not going to get a lot of market appreciation because when I'm buying it, the person selling it to me is getting all of those benefits because he made that property stable. So a lot of times people that buy very stable Class B properties, I wouldn't say that they're lazy. It's just they're really not pushing hard enough on behalf of the investors to get the value. So John Mark and I look for properties that actually are not managed well. It's a good area, it's a rising market, but the properties are not managed well. That's where we can get the market appreciation. And sometimes that has a downside. And the downside is the first year cash flow tends to be a bit lower. Now, it's more than made up for by the fact that the cash flow is going to start spiking in year 2 and then stay stellar usually all the way through to year 5 because it tends to be a 5-year hold. But the first year's cash flow tends to be a little bit lower than a stabilized property. Not true for you Californians, because you'd be lucky to actually get 2% or 3% in California. Another reason why at the current time we don't buy in California. I am not saying that there aren't good deals in California, but I would say instead there are no good deals on 100 units and above in California, though that market has been picked clean. But there are plenty of deals that you can find in the 5, 10, 15 unit area. If you're looking to do that yourself, Stockton and Sacramento are two good markets in California at this point. All right, so how do we figure out where to go, right? It's a big country. How do we figure out whether we should go to Dallas or Chicago or New York? Well, the nice thing about real estate is there are predictable market cycles, and they create what are known as emerging markets. Now, and these markets move up and down in a cycle, and investors know how to read the cycles, and we time our investments accordingly and enter and exit markets. The nicest thing is that real estate markets don't move in tandem with each other. For example, I'll tell you right now, the market at the very bottom and moving up here is Chicago. So it started moving up about 9 months ago. Construction cranes started appearing and have been going for about 6 months. So my guess is it's right about here. Dallas, on the other hand, the construction cranes appeared 3 years ago, so it's somewhere here. San Francisco is not here. It's here. It's all at this point. That market is hotter than any other market that I've seen, and it's just waiting for something bad to happen before it drops. So right around here. So what this goes to show you is different markets can be at different points in the cycle. So there's always emerging markets in the United States. There are emerging markets in California right now. Sacramento is right about here. So there's still people can buy, and yeah, it's a little bit risky, but they probably can ride it up a fair ways to this point. So that's really what we do. We sell around seller's market 2. We typically do not wait for the market to peak because it's very hard to time that. So when we get to seller's market 2, that's when you know, we've seen a lot of people leave much earlier. They've left too early, and inventory is tightening, and so we exit markets. It typically takes us 4 to 7 years to exit a market. So that brings me to the length of investment. Well, 2 to 7 year investments are common. This is not a fix and flip business. There is some fixing to be done. Hopefully there is fixing within the property because that's how you bring value to it. But investors have to be prepared to invest for that time frame. Now, here's one of the disadvantages of multifamily over single family. Single family investments tend to be liquid. Now, if you're renting them out, they're not really that liquid because if you have 9 months left on a lease, well, you can't go sell that home, right? Who's going to buy a home that has a tenant in there for the next 9 months and very poor cash flow, especially if it's California? So, but if you were buying a home and you were keeping somebody on a month-to-month lease, I guess you could get rid of a tenant whenever you wanted to sell it. So there was more liquidity there. And in my example, I said, well, if there's 9 months left on a lease, well, it's still kind of liquid. You just have to wait 9 months. In a multifamily investment, your money is in that investment for 2 to 7 years. Now, 7 years is the traditional number. In the last 10 years, the numbers have been much smaller. One of our financial attunement properties is in Houston, and it is now selling, and we haven't yet completed 2 years. The investors have almost doubled their money. So we're at the 45% percent level when it comes to that particular property. Is that typical? No. It's selling too early, and it's much too profitable. So it's neither one of those two are typical. My point is, right now the investment cycle is just a little bit shorter than it tends to be. So keep the time frame in mind. Now, if the property is doing well, as most of them tend to, I'm sure your co-investors will buy you out if for any reason you needed money. But keep in mind the worst case scenario is it's not doing well. In that case, you've got to stay in it, so your money is not liquid. So here's why multifamily values are less volatile than single family. Well, firstly, they don't tend to go up as much as single family, which is why they also don't tend to come down in a recession. Also, multifamily isn't recession proof, but actually is recession resistant. Have you thought about it? If a recession happens, what happens to all those people that can't afford single family homes anymore? Well, they go to multifamily units. What happens to all the people that cannot afford Class A apartments in San Francisco anymore? Well, they go to Oakland. So what happens is the B apartment people move into the C's, the A apartment people move into the B's, and the homeowners move into sometimes the A apartments or the B apartments. So what tends to happen is we tend to actually get a little bit of an occupancy boost. We might see a slight increase in delinquency because people don't pay rent, but we also see an occupancy boost. So that's a wash. So we often tend not to see much of a negative effect in a recession. So classes of multifamily buildings, I mentioned this a slide ago, Class A, Class B, Class C. Well, Class A is high rises, metal and glass, fantastic amenities, affluent tenants, the rents are way above average. San Francisco right now is $4,000 or above. Buildings are generally newer. They tend to be newer than 20 years old. They tend to have higher quality finishes, so granite countertops and stainless steel appliances. Great amenities, right? So they've got indoor pools, they've got gyms, all of those things. And there's no deferred maintenance because in a Class A building, when something breaks, you just fix it. And if it looks like it's going to break, you just fix it. That's normal for a Class A building because it's expected. Now the problem with Class A is very low cash flow and upside for investors. So cap rates are usually around 4%, which means that if you invest $100, you probably make $4 a year. And well, the 5.5, I can tell you, doesn't occur in California. It might happen in Arizona. There's a number of properties that are Class A properties in Arizona that might be in the 5.5% range, but not in California. Now, a lot of the buyers are institutional investors. So these are folks that are pension plans and funds, and they're fine making 4% because they know that it's going to appreciate. So in the long run, I'm not saying Class A buildings make 4%. They don't. They actually make a lot more. In some cases, they can match the yields of Class B and Class C, but they have much lower risk. They're very easy to manage because the tenant quality is so high, and institutional buyers usually invest for the longer term. So they don't mind leaving their money in there for 5, 7, 10, 15, 25 years even for properties that have been purchased in areas like New York, San Francisco, and Chicago. And the one downside is cash flow for A's is very sensitive to recessions. It is not atypical for it to drop 10% even for minor recessions. That's the downside. Now B's are much better. B's are I like B. I don't invest in B much, but B's are pretty good. They're competing for a pretty wide range of users. Rents are average. They tend to be about 20, 30 years old. Finishes are fair. Some of them, depending on the area, you might get granite countertops, but generally finishes are good and they've been updated in the last 5 or 10 years. Good amenities. Some Class B's have tennis courts. All of them have gyms. Some have pools. So they tend to have better cash flow than a Class A building, and cap rates tend to be a mix, 5.5 to 7.5%. In California, the 5.5 number applies. But in other states, you can get decent Class B buildings that are 7.5 cap. So what that means is if you invested $100, you'd get $7.5 back in a year. So you get a mix of institutional buyers. They've started liking Class Bs more in the last 10 years, and also private buyers such as us that buy Class B. Now Cs, in a way, is where the magic is. These are older buildings, so they're more than 20 years old, and they're typically in less desirable locations. Hopefully, when we buy them, they're in locations that are about to become more desirable, meaning emerging markets. They're almost always, in my opinion, in need of some renovation, some updating. So things like roofs need to be changed, gutters are leaking. Those kinds of things are very normal in Cs. So we tend to have a big rehab budget when we go into a C. Rents tend to be lower, and this is the one that has a higher level of mismanagement because many of them are cheap enough for individual owners to buy them. And John Mark and I actually specifically look for individual owners. We don't look for owners that do professional management. We look for owners that are trying to manage properties themselves because they usually tend to do a terrible job. And that's where our opportunity is. Cap rates typically are higher than 7%, not in the Bay Area, but in the rest of the US tend to be at 7 or above. Highest cash flow, and you get a lot of upside now. What you tend not to get is they tend not to be trophy properties. What that means is very rarely will somebody like Neil or John Mark come to you and say, we're going to hold this property for 25 years. It's cash flowing And I think that in 25 years, it's going to be worth 5 or 10 times as much. So these are not the sort of properties that you hold for a very long time where the same management is holding it from 1989 to 2015. That tends not to happen with seeds. So there's also a D category, and I think D stands for don't buy. At least that's what I think. And they tend to be much older. They're in rougher areas. They're not our market, but many of them have astonishing cash flow. It's just the headache of managing them is tremendous, so we tend not to get into it. So, you know, you learned a lot about multifamily. You learned about all the different aspects of multifamily. Now I'm going to tell you about a bunch of trends, and these trends are all new in the sense that they've only been around for 5 or 10 years or less, but they're driving astonishing growth in rents and astonishing growth in valuations. But before I do that, let me take a question. All right, so, well, actually, that was Ian saying, yeah, Sacramento. Well, Ian, I would say Sacramento is probably the only decent market in California for folks like us that are looking at greater than 100 units. Having said that, it's a tough market because there's a lot of money sloshing around Sacramento right now. A lot of other people know it. But it's still a market where decent deals in the larger units can be found. Thanks, Ian. All right, back to trends. So the first trend is, and some of you already know this, but understand how critical this is. There's a fundamental shift that's taking place across America, and it is that rent is the new buy. Americans prefer to rent. Now, a lot of you are saying, well, wait a minute, home prices are going up. How could that be true? The answer is simple. There's very little home inventory that has been created in the last 6 or 7 years, except for maybe the last 12 months when more inventory has been created. But secondly, millions upon millions of the homes that were owned by homeowners are now actually owned as rental homes. So that's actually driving the inventory down. But less and less Americans are looking to rent, and in the coming slides, I'll just show you just how massive the difference is. So why is this happening? Well, let's look at this survey that was done by the Wall Street Journal and Appfolio. Only half of all renters said they anticipated becoming homeowners in the next 5 years. This number is lower than it's ever been. For them, ownership just isn't in the cards. Renters are also more committed to renting than they've ever been. So if you look at these numbers, 1 in 5 apartment dwellers and 1 in 4 individual property dwellers, that is single-family tenant renters, plan to stay where they're living for 5 years or more. Think back before the recession. Could you imagine people saying stuff like this? No, they were like, I'm just here until I buy a home. But that number now has gone up to 20% of apartment owners and 25% of people that are living in single-family renters that are saying, I'm going to be here for five years or more. That's really great news for those owning apartments, because one of the most expensive things about owning apartments is turnover. So now that people want to stay in longer, you're going to get higher rents longer. So what about the people that qualify for mortgages? Here's an interesting statistic. Less than 1/3 of renters cited the inability to obtain a mortgage as the reason for not buying. What this means is 2/3 of them simply chose not to buy. I'm not sure why this is. My guess is it's because they've seen their parents go through a catastrophic real estate depression, and so they tend not to want to buy. Or older folks that have been through the 2008 depression now are wary of buying homes. But whatever it is, it's causing a massive change in the way America lives. So another poll indicates that the majority of renters indicated that they rent because they like the lifestyle rather than because of the inability to get a mortgage. Why? Because they want the good schools. They want the safe neighborhoods. They want the parks and the playgrounds, the community centers. They want friendly neighborhoods. Well, sometimes it's easier to get that when you rent than when you buy, because when you buy, especially in California, you get priced out of all this stuff. Think back to your own experience if you live in California, at how difficult it is to get into a neighborhood that has good schools or has, or is a safe neighborhood. So many people get priced out of that, so they say, well, let's just stay in the safe neighborhood and rent. Here's the biggest one. This is enormous and is becoming bigger each year. The millennial generation is different from Gen X and Gen Y. They are not buying at the same rate as previous generations. And now I want to point out the peak here. You see this peak right there? Notice that this peak was hit 3 years, roughly here, 2005. It was hit in 2005, 3 years before the real estate recession started. What does that mean? These folks were already choosing not to buy homes. So from a peak of 17% home ownership amongst this super important category, 18 to 34 years old, we are now down to below 13. This is 2014. The number has continued to drop since then and is now below 13%. Well, if 4% of this massive group do not buy, what that means is we need millions and millions and millions more apartments than we currently have. Enormous trends, all driving multifamily forward. Here's another one, a big one. We've got 75 million of these baby boomers. Well, a whole bunch of them, not all 75 million, of course, are looking to downsize. So they're either moving to urban apartments because they want the convenience, or they're moving closer to kids who want to live in the city. But whatever the reason is, it's very clear that echo boomers are moving from single-family homes to apartments. So you see the trends. I mean, by themselves, any one of these trends would be phenomenal to have, but there's 5 of them. And together, they've driven incredible gains in multifamily in the last 5 years. But the runway is just beginning, because what these trends are saying is we are millions of apartment units short, and it's going to take us a decade to catch up. So how do you benefit from these trends? Well, you benefit by buying together or leading a buy. So there's many people in this presentation that have indicated to me that, oh, I don't want to invest. I'm not a passive investor. Maybe I don't have money. What I want to do is I want to buy units and involve other people and make money from it. Well, either way, the same principles that I'm about to show you apply. Let me take a quick question. All right. So, the question from GT Okamoto is, this fact is fascinating regarding commitment of folks to stay where they are today. Could you let us know where and when this data is from? Absolutely, Mr. Okamoto. The data is from Appfolio. So if you go to Appfolio, actually you can Google this on the web, it's easier. Type in Appfolio real estate infographic, and you'll see a very long graphic. I took portions of it. So this Appfolio is a property management software for apartment rentals. They do millions and millions of units. So who better than them to study apartment demographics, right? They've got this enormous amount of data coming into their system every week. So they teamed up with the Wall Street Journal, and together they did this massive infographic, and the whole thing is worth looking at. So please Google it, and if you have any trouble with it, just drop me an email and I will send it over to you. It's about 4 feet long, and it goes into depth on all of the data. So that's where the data is. Once again, Appfolio and Wall Street Journal. Let me push this aside. All right. So back to how can groups of investors buy multifamily complexes? Well, they buy through a concept known as syndication. So in syndication, right, a bunch of people get together and they follow rules that are governed by the SEC. This is very important to understand that when you go through syndication, for those of you who want to do this, even if you're buying a 10 unit and you want to get a bunch of people together, I want to caution you. Understand that this is governed by the SEC, and you put yourself at risk if you do not understand the rules. And the rules are pretty stringent. People have been more than slapped on the wrist for this. So Google SEC real estate syndication rules. So we have a structural process that we have to follow as syndicators. So what happens is an experienced syndication team finds an asset to purchase and then offers that opportunity to pre-screen investors who then choose to participate or not in the acquisition. Now, the investors get 70% of the proceeds. Typically, the team gets 30%. Now, if you're buying a Class A, the management team typically gets 20% or even less than that, because a Class A asset is much more easy to maintain and typically will yield less money. So the the syndicators take less money because your profits are lower. With Class Cs, where you can have much higher upside because the property has to be turned around, the team spends a lot more time, so a 30-70 split is normal. So individuals, self-directed IRAs or retirement plans, solo 401ks, I believe, would work, or entities. A lot of times it's hedge funds that invest in these, pension plans that invest in them. So they invest different amounts. So one person might invest 25,000, another one 50,000, another one 100,000, and somebody else might invest $1 million. So they receive a proportional equity share, both of the cash flow and of the back-end value gain when the property is sold. So the syndication team, well, they've got to do all the work. They find the asset, they contract it, they do all the due diligence, then they organize the whole offering, and they pool the investor funds, and they manage the property until sale, usually for 3, 4, 5 years. So to do that, they receive a share of the cash flow and profits and a small management fee or asset fee. Now, anytime a syndicator tells you what your returns are, make sure that they're telling you those returns net of the team's cash flow, the team's profit, the team's management fee. You should only be ever hearing about your net returns. So the management team usually assigns an asset manager, and that's what that small management fee is for. And then the asset manager manages a property management team, and those are all full-time employees that work at the property. Investors have no involvement, no tenants, no toilets. Now cash flows, which is because all of these properties are cash flowing, right? So each month there's cash flows. Now they're typically dispersed quarterly because it's a lot of work to calculate and disperse cash flows to investors. Now, very often, investors receive preferred returns before the management team is paid. This is very important. It's certainly true for us. So what this means is, let's say we say your preferred return is 8%. What that means is if you invest $100, you should get $8 back each year as your ongoing profit. Well, let's say the property only had $7 in profit. Well, in that case, the management team doesn't get anything at all. The investors get preferred returns. So let's talk about why invest in multifamily, the top 6 reasons. Now you might say, well, wait a minute, Neil, didn't you already do that? You talked about the trends? Yes. But what happens if those trends go away 3 or 4 years from now? What happens if the millennials change their mind and decide they love single family? Well, the reason we invest in multifamily is not because of those trends. They're just gravy. We invest because of these 6 trends. But let me take another question before I get into the next section. Very good question from Cindy Johnson. Cindy says, is the multifamily class system universal? Is it subjective? How do you really know which class, or is it a class system you developed? Certainly not a system I developed. The system's been around for 40, 50, 60 years. It is highly subjective. So what I see usually is I see 100% of the people that are in the real estate tend to get the ABC right. What they tend to get wrong is I've seen people describe a property as a B minus, and another broker describe that property as a B plus. So there's a little bit of a gray area there. Same thing with properties that are C plus, sometimes being described as a B minus. Very subjective system. You have to be careful, but there are certain benchmarks, and I gave you some of those benchmarks. Properties older than 20 to 30 years tend to be C properties. Properties that have almost no amenities are almost always C. So in a C, you typically wouldn't see a pool. You wouldn't see a gym. But almost every B has a pool and a gym. So there are a lot of general conventions that are to be applied, but keep in mind that you probably want to ask 3 people about a certain property, and if all 3 of them say it's a B plus, then it's a good chance that it is a B plus. But don't listen to a single person saying that this property is a B plus or a C minus. Hopefully that answers your question, Cindy. I'm going to keep going. Now, number 1 reason to invest in multifamily is a fairly obvious one, cash flow. If it is not cash flowing, don't buy it. I keep saying this, and I have to say this, that only in California do people buy multifamily properties that have either negative cash flow or 1 or 2% cash flow. This is purely a Californian phenomenon. I'm not saying there aren't lots of rich people in New York or anywhere else, but it seems like only Californians are willing to do this because they have a belief that their multifamilies, the small multifamilies, 1 unit, 2 units, 3 units, 4 units, will appreciate just like multifamilies will. Those are the sort of people that usually get into cash flow trouble. So if it's not cash flowing, don't buy it. So exact returns will depend on the property you invest in, but double-digit annual returns are common. Now, those of you who live in California have probably not seen any of these double-digit annual returns. My feedback for you is that's why we don't invest in California. If you would like to continue banking on continued appreciation in the California market, then you probably should buy those. I wouldn't. Another one of my presentations is the San Francisco Bay Area Health Check. I did that about 4 weeks ago. It's on YouTube. Anybody that wants that link, I will send it to you. I am very critical at this point of the San Francisco Bay Area's real estate market. It is my opinion that the market will either flatten or decline. So if you're going to buy a multifamily here and it's not cash flowing, you're taking an incredible risk with your investors' money. Don't do it. Reason number 2, we talked about this one a little bit as well. Remember that $750,000 example where I said, oh, $25 a month for 200 units becomes $750,000 in forced appreciation? Well, that's what I'm talking about here. If you double the profit, you double the value. And no, you don't have to wait 5 years. If the property was done horribly and you doubled the net operating income in 6 months, yes, you can sell it for double that value in 6 months. And a lot of people do it. The Houston property I gave you as a perfect example, our forecast was over 5 years. Well, the property doubled in value in 2 years. Somebody made us an offer for $10.3 million. We're selling it. It's in contract and should be sold within the next month. So it's very important to understand that single family cannot get forced appreciation because it's not measured by income. One other principle that applies is the more distressed the property, the deeper the discount, but also the greater the risk. So if you are investing with a syndicator, make sure they have a track record of turning properties around because it's more work for them and some of them are really not willing to put in the work. So they'll close the property, and by closing I mean they'll buy it, and then they won't put the work in. So it's very important to have experienced managers, experienced rehabbers when you're going into projects called value play. Value play means repositioning. Value play means a property that needs improvement. The third reason, and this is really my favorite reason, with multifamily, when I walk into a multifamily, I can talk to a property manager and I can give him a list of metrics. I can say, okay, so what's your occupancy? Okay. What about your economic occupancy? Okay. What's your delinquency level? Okay. And how does it vary throughout the year? Okay. And yeah, and what are your maintenance levels? Now, every single property manager in the United States that managing a multifamily either knows the answers to this question or is not going to be managing that property for long. So I love the fact that multifamily is like a business. It's almost like when you run a business and you're a CFO, well, every CFO has the same metrics. Well, we apply those for multifamily. This allows us to do remote management effectively. For most properties, an MMR, a Monday morning report, is provided, usually on Monday mornings, which shows you how the property is done in the last week. And usually in Monday afternoon, there's a call, sometimes with one property manager, sometimes with multiple property managers on the phone, where we discuss all of these metrics. So you run it exactly like a business. I love it. I'm an engineer, so to me, the elegance of the metrics is really why I invest in multifamily. Fourth one, well, this applies to all real estate, right? So inflation protection. You've had a Fed that has, over the last 6 years, printed trillions of dollars of money out of thin air. Now that the Fed has stopped, every other nation in the country in the world seems to be picking up. Japan is carrying out the largest money printing experiment in history. The Eurozone is hiding their monetary expansion under various names, but they are printing over $1 trillion a year. Well, guess what happens when everybody in the world is printing money? Well, the value of money goes down. Well, what happens to real assets? The value of real assets goes up. So in an inflationary world, it's very important to buy real assets. Now, for the purposes of this slide, I think any kind of real estate is just as good, including land. Tax benefits. So multifamily properties are able to take advantage of depreciation on the building and also on the equipment to help offset income. Now keep in mind, you do get the same tax benefits with single family. However, we tend to be a little bit more clever in the multifamily arena because we have massive properties. For example, our Dallas property is 248 units. It is easier for us to pay for the accounting work to do accelerated depreciation. Because on a single family, all you're really going to get is 1/27th of the depreciation each year. Well, we tend to get accelerated depreciation very often. It's an expensive process, but we can afford to pay for it because there's 248 units. It's a very large project, so we can afford to pay for that. So we tend to get tremendous tax benefits, tax sheltering, and also tax deferral. Huge, huge benefits. For those of you that are savvy, you can also 1031 from one multifamily to another multifamily. So I have another question, so let me take that one. So sorry to go back a step, but what sources do you use to identify emerging markets? So great question, Michael. Many different sources. So one of the sources is John Mark and I are part of the Dave Lindahl community. My partner, John Mark, just won the Multifamily Hall of Fame Award from Dave Lindahl, who is known as the best-known guru in multifamily. He's the one with all the best-selling books for people that get in. So we pick it up from the network. But there are a number of other ways in which I pick up sources. So if you have a pen or piece of paper, write this down. Marcus and Millichap publish 4 times a year quarterly reports. I read all of the quarterly reports from all of the big commercial brokers. I can tell you Marcus and Millichap is by far the best. These reports are incredibly beneficial. Technically, they only go to Marcus and Millichap clients. However, by searching on the keyword Marcus and Millichap quarterly report 2015 or whatever year you're in, you're guaranteed to find them. They're phenomenal. They cover 50 metros, and they will tell you exactly what you need to know. So how do you spell Millichap? M-I-L-L-I-C-H-A-P. Marcus and Millichap. Google them. You'll find what you need. Now, and I also have Hakeem's asking for that link. Yes, I will send you a link to my San Francisco Bay Area Health Check presentation. In fact, when I send this webinar video and the PowerPoint slides out to you, I will send you a link to that presentation. All right, let me go back to the presentation. Thank you for all the questions. This is phenomenal fun for me. So I think of all the reasons, though, the one that you should care about the most is economies of scale. Huge economies of scale. And what does that really mean, right? Well, firstly, if you have a single family unit and the tenant moves out, you lose 100% of rent. If you have a 250 unit and 10 tenants move out at the same time, on the same day, your vacancy went down by 4%. It didn't go down by 100%, it went down by 4%. Massive difference. Marketing is easier, right? Because you're driving everybody into the same location, into the same rental office. Logistics are easy. You tend to have a centralized location for maintenance. You've got one shop. All of your people work in the same area, and they come to work in the same place all day. Dedicated employees are always easier to manage than contractors because you control their time, right? So you can question them about all the 8 hours. What were you up to in the last 8 hours? What unit did you rehab, right? And the last one is very important. Upgrades can be carried out with less impact on revenue. Because what if the area is doing well? The area is going from a C to a B. Well, it's gentrifying, right? What that means is, what should you be doing? Well, you should be upgrading the units. It's time to roll out the steel appliances. It's time to do the granite countertops. Well, when you do that for single family, you have to take the home offline. You can't have a tenant living in there when you're installing granite countertops, right? So you lose rent. Well, you don't do that for multifamily because in a well-managed unit, in well-management multifamily that's 250 units, even a 96% occupancy means 10 units are vacant, right? So while you rehab those 10, and as soon as those are rented, another 10 are going to be vacant. So you're constantly rehabbing, but there's no cost of rehabbing. There's no rent cost. Now on top of that, sometimes there's no cost of labor either. Remember I told you every property has a lead maintenance guy and a junior maintenance guy? Well, lots of times if the property is rented out, nothing is broken, well, what are they doing? Hopefully they're not smoking pot. Hopefully they're in one of your units where you've given them the materials and said every time you have nothing to do, you're going to go to 217 and you're going to rehab that sucker. Well, now you have no labor cost. You're just doing it as you go. Economies of scale. Absolutely marvelous. So those are my top 6 reasons. There's 4 more. If anybody wants, I can send those to you as well. But these are the top 6. And now I'm going to go into life cycle of a multifamily project, but I'm going to take a question before that. Well, thank you, sir. Yes, please. Okay, all right. I will send those out. So that wasn't really a question. All right, so life cycle of a multifamily project. So now you're about to learn what we do, because this is really our life cycle. And 100% of what you're about to do, we just did with a property that we have under contract. Every single step of this we've done, or actually the pre-sale steps we've done, the post-sale steps we will do once we complete the sale. So there are 4 phases in the life cycle of a multifamily: the pre-offer, the post-offer, post-purchase, and sale. So let's start with pre-offer. So this is where you do the metro research. This is where the Marcus and Millichap stuff comes in. You do your research, you pick a metro, and then you travel to the metro. And then you go look at jobs. By the way, Marcus and Millichap will have jobs. For every one of those 50 metros, they'll tell you what jobs are in there. For every one, they'll have sales trends and rent trends. That's why I love them. They make my job of doing research much easier. Doesn't mean I'm done, but it gives me a fantastic start and saves me a lot of airline tickets when I'm going into a metro. Now, once you're in the metro, then you start researching what is known as path of progress. Extremely important concept. And pay careful attention for those of you that want to do this yourself. Path of progress is like an amoeba. It's like an organism that is moving through a large city. And it's the direction in which progress is moving. So let's see. I'll give you an example in Texas. Now, if you look at Texas, if you look at Dallas, and imagine Dallas, it's like a circular city. So it's a big circle and actually has circular roads. Well, if you look at the path of progress over the last 15 years, a massive percentage of the path of progress is in the upper half, right? So Dallas Old City is on the lower half, and then some of it is off on the top right. So that's where Plano is, that's where McKinley is, that's where the big Chevron plant is going. Path of progress is you figuring out what has happened over the last 5 years and where are homes getting more expensive. Path of progress is not easy to do. It takes a lot of effort, because what you're doing is you're trying to figure out pricing over time. And there's a number of tools on the web. Zillow and Trulia can help you with this, because what you're trying to do is say, okay, well, in this zip code, how much did prices go up in the last 5 years? Oh, well, they went up 17%. Okay, what about that one? That's 13%. What about this one? Oh, 3%. Okay, well, are the 17 and the 14 close to each other? Oh, those 2 zip codes are next to each other. So you start drawing a path of progress. And as you draw over a city map, eventually you end up with a odd-shaped area that seems to be gaining. Well, 2 things are happening. The good tenants that were in the other parts of the city are moving to this area. So there's gradual migration that's happening there. Sometimes, and I hope you don't take this as a racist comment, but white flight is an example of path of progress, right? So I'm not suggesting you follow whites. I'm suggesting you follow the path of progress. So look at those. Look at pricing trends. It's very important to do this research, because half the battle is won if you already invest in the path of progress. Everything becomes easier. Then, once you figured out the path of progress, that odd-looking shape area, you create your team. You go to the realtors. You tell them, I want to be inside this area. You find the local inspectors that know the local rules. Remember, rules in Chicago are very different from rules in Texas. You're going to have completely different problems around inspection in Chicago than you would in Texas. So you cannot apply your Texas knowledge. You have to get the local inspectors. You've got to find the local property managers. They'll give you fantastic insights. Cities are different street by street. You'll have a property manager that's been there for a long time, and he'll say, anything beyond 71st Street, I wouldn't touch. Stuff like that is very important, because they've been there. They know those areas better than you do. And then contractors. The contractors will give you an idea of what maintenance is for the city, because different cities have different maintenance rules and even norms. So in some cities, maintaining a property a certain way is acceptable. In a different city, a different level is acceptable. Well, since you're going into the city, you need to know that level, and the contractors are going to tell you that. Now, you found that odd shape, and you start looking for opportunities within that area, and most of it is by driving around or calling the local Cornish and Carey, the local Marcus and Millichap, the big commercial brokers. You start calling them and talking with them. And then you start walking the size of property that you want. It's very important that you know what kind of property that you're investing in. For those of you that want to become multifamily syndicators, the worst thing that you can do is walk into a local Marcus and Millichap office and say, I'm looking for a multifamily property, okay? I mean, right there, you painted a rookie sign on your head, right? You need to say something like, I'm looking for something in the 100 to 150 unit range. I'm somewhere in the 50,000 to 75,000 a door price range, and my zip codes are blah, 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 blah. Now, do that research before you walk in there, and all of a sudden you'll notice that they give you fantastic amounts of attention. 3 of them will cluster up next to you and start telling you all of their stories about that area. But if you walk in and say, I want to buy a multifamily, no one's going to pay any attention to you. So now, let's say they give you an opportunity, or you start building a network. Sometimes inspectors will tell you about properties that are off market. The best properties are always off market. Our property in Chicago never came on the market, never got listed, which is why we got it for a much lower price. But contractors will tell you, and sometimes realtors will tell you about properties that are not listed, because they want, obviously they want commission, so they don't allow the property to be listed. So make a first offer, but for multifamily, know that it's not like single family. First offers are almost never the final offers, especially for big ones. So make a first offer based on the seller's financials. The seller will have this big package, sometimes it's 50 or 100 pages, of what is known as pro forma. So they say, here's how much money our property is making, these are our rents, these are our collectibles, this is our net operating income. And on the basis of that, you write them an offer. Don't worry about it, just write them an offer. You know that you're going to do your due diligence. And that's where phase 2 starts, which is post-offer. So in your post-offer phase, you do 3 massive levels of due diligence. And for a 200 unit, I'm talking about several thousand hours of work, It's split up between you and contractors and property managers, but it's still an incredible amount of work. Why? Well, for our Chicago property, we had 6 roofs. The sewers were collapsed. We needed to send cameras down through them. There were a lot of repairs. We had to walk 237 units. We had to look at, how the carpets were. A lot of them need to be changed. The hallways were so dark and dingy that the first thing that we're going to do is paint all the hallways and change the light bulbs from 20 watts to 60 watts. The exteriors had problems. This is a property in Chicago, and Chicago gets very cold in the winter, and so when it rains, the water freezes in the cracks between the bricks, and over time, when that ice melts, the bricks tend to split, and so if you're not filling in that mortar between the bricks, over time, the bricks start falling on people. So you've got to do something known as tuck pointing. Well, this property that we're buying needs tuck pointing, so guess what we're doing the first day of purchase? Electrical. You've got to look at electrical, especially because C properties tend to be older, so you've got to make sure that electrical is done properly. Plumbing tends to be one that's really overlooked. For this property, we had to send cameras down the sewers and got $100,000 in credit from the seller simply because his sewers were collapsed. So it's not, this is routine stuff for people that have checklists, but what I'm trying to point out is that the checklists are dozens of pages long. Mechanical, so you're looking at HVAC, boilers, you're looking at heaters, because those are big ticket items. If a boiler goes on a 200 unit building, you're looking at $50,000 to $100,000. The second part of due diligence is, did they really give you the right numbers? And more often than not, they didn't give you the right numbers. So you have to verify the financials. Are their rents correct? Are they coming in on time? What about occupancy levels? They said 94% occupied. But when we walked through the units, we noticed that 20 of the units were not occupied. Wait a minute, that comes out to 89%. So you go back and check and they say, oh yeah, people left. Or, oh, we didn't know what was happening with that unit. All kinds of nonsense is given to you. Delinquency. So they say they have 5% delinquency. You start looking at the rents and you notice that 11% of the rents are late. Obviously, then the delinquency is different. Staff competency, long interviews with staff going over what they're doing, what their day looks like, do they understand the metrics, things like that, all very, very important. Then the third phase of due diligence is not done at the property. Then you start walking comps. So you walk around all of the different properties around this area. So you walk everything around the area that's in the same price range. So don't bother walking an A if you're buying a C. Don't bother walking a property that's $100,000 a door if you're buying it $50,000 a door. You've got to find comps that match your property. And hopefully you come back with, I've got the best one. So that has happened to me sometimes, and sometimes it hasn't. Sometimes I still go ahead and buy. The Chicago property was a clear and far away winner, but many properties are not like that. Then you really have to make a decision on, is it good enough to buy? Now comes the fun part, and this is, well, I'm being sarcastic when I say it's fun. This is the most nasty part. So you start going back to the seller and you start showing him all of the things that have to be repaired. And some of them are just delusional. They just don't think that any of these things, oh, sewers, yeah, I've had the same sewers for 20 years. They're collapsed. You realize you're polluting groundwater, right? This is going to be a big fine from the city. I need to fix it the day that I move in. Oh, no, I don't think you need to do that. So sometimes it goes well, and sometimes that's where the deal ends, because we will not take the property on without a full-scale repair credit. So Chicago, for example, has $500,000 plus $250,000 in repair credit. So there's $750,000 total. Guess what our repair bill is? $850,000. We didn't get as much as we wanted, so we had to have $100,000 come out of our equity payment when we buy the property. But that's how it goes sometimes. A seller may not give in on every piece. But that doesn't mean that we're not going to fix those things. We still have to fix them when we move into the property. So sometimes bad stuff happens, like this. The seller doesn't agree, and then unfortunately we restart at phase one. So all of the effort that you put in so far goes to waste, and you restart at phase one. Let me take a question. So yes, I did mention that, Jennifer. I will be sending both the PowerPoint and the video. So you will get this entire webinar on video sent out to you, and you'll also get the PowerPoint slides as a PDF. Don't worry. All right, so the next phase is the team starts to promote the opportunity. So we go out to our investors, we go out to potential investors, and we start doing webinars. Now, are you in that webinar? No. That webinar looks very different. So that webinar is going to be an hour on the property, pictures of the property, videos of the property, walk of the neighborhood, comps, how many studios, how many one bedrooms, how many two, how many threes, what are the rents on those, what are the rents on my comparables, what about Section 8, what about crime, what about employment in the area, what's the ethnicity of the people living there, so on and so forth. So are you watching that webinar? Not quite. You're watching Multifamily Fundamentals. That would be a completely separate webinar. Everyone in the room is asking questions about return on investment, IRR, and cash flow levels, assumptions for exit, time of exit, asking questions involving self-directed IRAs or 1031s, things like that. So it's a different experience. And if any of you want that experience, send me an email and I'll put you in one of them that's coming up in the future. So lawyers at this point start creating legal entities to protect investors and management teams. One of the nice benefits of multifamily that you do not get in a single family is every experienced multifamily syndicator is paying tens of thousands of dollars to SEC lawyers. And these people know how to protect your assets. That's all they do for a living. They just move from one multifamily to the next multifamily, and we pay them a lot. My lawyer is $450 an hour. So these people structure the LLC. And me, because I'm in the management team, actually have a little bit of exposure because my LLC is designed to stand in front of the LLC that you're in. So all the investors, if you're investors, you stand in an LLC, but because you're not managing the property, you're very, very unlikely to get sued. It would never hold up in a court, but I can get sued successfully. So that structure process is set up by lawyers. So purchase usually takes about 75 days, and then the property gets handed over. Oops, well, those two slides need to be flipped around. So about 75 days from start to finish is this process. Sometimes it takes a little bit longer, 90 days, even 120 days are fairly common. Now, we bought this sucker. It's $10 million, we bought it. What do we do with it? Well, we first got to decide what to do with the property management team. That always comes first. Our decision on what to do with the property management team is usually made 45 days before purchase. In the case of Chicago, the property management team was so bad that we made our decision 2 days after walking the property. We're not keeping any of the 5 employees. So everyone has to go, everyone will be replaced, and we've hired our property management company. They're called TaylorMade. They manage 3,000 units in that particular area. So, and they're turnaround specialists. Usually you want somebody who's a turnaround specialist if the property has delinquency issues like the one in Chicago does. So management then makes upgrades to amenities. What we're going to do on our next property is we're going to paint the hallways, change the carpets, improve the lighting. There's external fixes where bricks are falling apart and they have to be tuck pointed. Not a lot of internals on our next property, but sometimes you have to rehab a bunch of units, change out kitchen cabinets and things like that. What we don't do, what John Mark and I don't do, is we don't get into gut rehabs. We don't get into rehabs where essentially the property has to be empty for months and months and you're fixing it up. We don't do that. We get into properties where 95% of the units are habitable. They may not be in great shape, but they have to be habitable. So then we transition out or evict undesirable tenants. So when we move in, the tenants see a very big improvement in customer quality or customer service. We are very fanatic about this. But at the same time, they get a message that there's a new sheriff in town. If on the 2nd they come in and pay their rent and it's due on the 1st, when they come in, there's already a 3-day notice at the table waiting for them, and they are not allowed to send in rent. They have to come into the management office, pay the rent, and the notice is handed to them. And they always act surprised. They're like, but I've been paying my rent on the 3rd for 5 years. And the answer is, you cannot do that anymore. But why are you giving me the notice? I'll do it next month. I'm sorry, that's our process. Here's your 3-day notice, please sign here. Now, very quickly, within a month, the tenants know that they can't be messing with us. And some of them choose to say, oh, no, I can still do it. They don't know that we are well-funded. And when that happens, we don't hesitate. We don't give the tenants a chance. We evict them. We evict them. Once we know that that tenant has a history of delinquency, we don't let them stay. And a lot of them come back and say, oh, no, I'm sorry. I want to stay here. I love this building. I'm sorry, sir. The eviction process is already fine. We don't take that back. So our repair budget is then the huge budget. For example, I mentioned $750,000 to repair. Well, we start improving the assets. We like to pave the driveway outside because that's the first thing people see when they come in. And then once we've upgraded the property over 90 days, maybe 120 days depending on the property, then we can start increasing rents. So as new people come in, they tend to come in at higher rent levels. And so the quality of people is higher because they can afford a higher level of rent. And then we start pushing on the maintenance pretty hard. And our goal is to enhance profitability. And then every quarter, usually at the very beginning of the quarter, investors receive checks. And whatever's the cash flow, they receive it. We get a portion of it. If we haven't hit the preferred number of the pref, which is usually 8%, then they get the checks. We don't get anything. But if we have done our job right, we both get checks. And we send a very long descriptive property report from the team out to those investors. Now, we've done the hard part. The property has been turned around. It's cash flowing beautifully. Well, we hold it. It says on the slide 3 to 5 years. The answer is we hold it until we reach exit projections. So remember that other webinar that I was telling you about? Well, everybody knows what the exit projection is. For The Chicago property is $16.1 million. When the net operating income of that property increases enough for the property to be sold for $16.1 million, we put it up for sale. And a lot of people ask us, why are you putting it up for sale? It's cash flowing 13%. I cannot invest my money, you know, at a 13% level elsewhere. And the answer is, but there are a bunch of you, and not everybody feels that way. So unless there was a unanimous vote of all of the investors asking to hold the property, we tend to sell it. And obviously at that point is the biggest portion of the profit that is handed with principal back to you. Hopefully you like what the syndicator has done, and you just take that money and flip it into their next opportunity. So, was that interesting? That's the whole life cycle, and that was a ton of steps. So you realize, I hope you realize just how different multifamily is from single family. And a lot of you are like, oh, too much work. I can never do this. Well, on the flip side though, it's not just more work, it's more competency, which is why it's a much larger industry. It's $2 trillion. And a lot of people say, well, single family is the largest industry than that. Yes, but take out all the people that own their own home, and you realize single family actually is not a big rental industry. It's multifamily that's the big 800-pound gorilla. It takes time to learn this stuff, but it's truly worth learning. Let me take a question. Question from Hakeem is, how many investors do you typically have invested in one property? Well, that depends on the purchase price, Hakeem. So a property like Chicago, where we are raising $3.5 million down, probably have 40 or 50 investors. A property that we did in Dallas, which was half that amount of equity raise, had 25 or 30. So generally, it tends to not be a number over 50. 99, by the way, is the legal limit for the kind of syndication that we do. But 50 is what most properties tend to max out at. All right, so you learned a lot of things today, right? So it still hasn't been an hour. We've got about 6 minutes remaining. So we learned about the size of the market. We learned about its unique characteristics. We now know that there's a once-in-a-lifetime broad market trend that's driving multifamily growth. Those of you who are interested in statistics, just Google what the rent increases have been in the last 5 years compared to the last 15 years before that. I think your eyes are going to pop open. We discussed the top 6 reasons why people invest in apartments, and these 6 reasons have nothing to do with these trends. These are 6 reasons that exist and have existed for more than a century. We talked about how groups of investors buy properties together, and more importantly, we went through the entire life cycle of a project. So now let's spend 90 seconds on next steps. If you like this, take action. And there's 2 different ways of taking action for you. So if you want to invest in a multifamily property, passive income, and you want to learn about an actual multifamily property, then go to this URL. So those of you that can write it down. You do know that this webinar and these PowerPoint slides will come to you, but it's really nice to go and take a look at it. What's nice is I would suggest you start with the high-def tour. What's interesting is for this particular property, we actually have a very special actor in the video. So all of you know him well. He's the President of the United States. He's building a $400 million library less than a mile away from that particular property. So check it out. It's a very fun video. And all the kind of numbers for that property are also there. If you want an opportunity list or you want to be on our list, that's info@financial-attunement.com. If you want to call us, feel free to call us. Now, for those of you that actually want to syndicate your apartment complexes, they're like, oh, man, I don't want to be a passive investor. I want to buy my own apartments, and I want other people to buy with me. The answer is these links are much more useful for you than even an investor, because within these links are 2 documents. One of them is called executive summary. The other one is called investment summary. The exec summary, as you can imagine, is for busy executives, so it's 2 pages long. The investment summary is 42 pages long. So those of you that want to be syndicators need to go through the 42-page document. And you need to understand the different sections of that document, because if you want to buy a multifamily and get other people to invest with you, you need to know every answer on every page. I know it's hard, and when you initially start, it's going to be almost an insurmountable hump, but then there are many ways of getting around that. One of them is Bob Peterson, the organizer of this group. He has a fantastic real estate program that you can go through. It's quite inexpensive, and he can teach you how to do some of these steps. The others, they come with experience. I mean, honestly, I don't know 100% of them. I probably don't even know 90%. John Mark does some portion that I don't know, and I do some portions that he doesn't know. So people tend to partner up. Early on, it's a good idea for you to get together with 2 or 3 other people. Where do you find them? Well, you're already in a meetup group. Try to find other like-minded individuals. Another great resource is Bob Peterson. Call Bob, explain you want to do this, and you want to buy apartment multifamily complexes. He will put you in touch with people. Right now, listening to me are 2 such individuals. One of them, Michael Allen, just asked a question a few minutes ago, and that's how we were put in touch by Bob Peterson. So leverage the meetup network, because early on you're probably going to need somebody else to work with, because you just don't know all of the different pieces, and so it makes sense to have other people working with you. So that kind of brings us to the end of this particular event. I will send you some more information, a little bit more information about Chicago, but for those that are actually interested in Chicago or want to attend a webinar, drop me an email, please. When I send you the PowerPoint and the video, just respond back to that email, let me know, and I'll put you in one of those. For those that are looking to learn multifamily and buy complexes, that's the sort of meeting you need to be in, because you'll see how investors grill us. And sometimes it's not fun having 20 or 30 investors shooting questions at you, because you don't have every single fact at the tip of your finger. So it can be a tough situation to be in, but we've survived, and that's why people give us their money. So I hope you enjoyed the session. I have more questions. This is a great time to be asking questions, by the way. Let's see. Is partnering up, so here's a question, and it's from Cindy. Is partnering up that you just described, finding co-investors in our meetup, for example, different than being part of a syndication? Well, yes and no, Cindy. So depends on the size of complex that you're buying. If you're buying a 5-unit or a 10-unit, there is a simpler path than syndication. Syndication costs tens of thousands of dollars in legal fees. But if it's a smaller unit, you can do it at a lower cost. And a fantastic resource to tell you how to go about it is Bob Peterson, who is the mentor of this group. So what I would say is, what's the best way for a newbie? 2 ways. One, if you want to go for the larger units, which is where you really want to end up in the long run, find somebody that's already done large units and partner with that person. If you want to go with smaller units, partner with anybody that really wants to buy smaller units and you think that they're competent and committed to multifamily, and partner with them, and then go to someone like Bob and say, well, I want to buy a 5 or a 10 unit. How do I do it? So someone like Bob can help you with that. Hopefully that answers your question, Cindy. More questions? Okay, good. Let's see. Any other questions? No? Did you guys enjoy the event? Give me a thumbs up if you did. No thumbs up. There we go. All right, here's more questions. All right. Woo, that's a lot of them. Here's a question from David Page. How do you set the percentage by which value must rise? Who makes decisions on when to sell? So let me answer the second part first. The syndicators make a decision on when to sell. Investors in multifamily are passive. What that means is they're not actively involved in managing, and they're not actively involved in making decisions. Syndicators decide when to sell, and they have the right to do that. How do you set the percentage by which value must rise? Well, we set exit projections. So for each property, the exit projections are really based on reality. I mean, we don't want to typically offer a projection that's more than 5 years longer, or longer than 5 years. So we look at where the net operating income is. Obviously, we get a rent boost every year, usually 2%, sometimes more. And so by doing that and projecting it into the future and selecting a cap rate for the future, so sometimes you select the same cap rate. You say, okay, this area is not going anywhere. It's still going to have the same cap rate in 5 years. However, if you think that the area is gentrifying, meaning a C minus can become a C plus, then we might select a lower cap rate, which gives us more money when we exit. So by selecting those numbers, we come up in our projections with a final sale number, and then those are the ones that are shown to investors when they come in to invest. So when we are in the investors webinar, we show them our exit numbers, and we say, whenever we hit X million, you will have this return and this annualized return, and we will sell the property or put it up for sale. So hopefully that answers David's questions. Well, we are exactly on time. We have 3 minutes over, so I'm going to end the event at this point. If any of you have individual questions and you want to send them to me, feel free. You can also send them out to Bob Peterson and copy me, and we will answer you. You should see PowerPoint slides and a video in your email sometime tomorrow. So I will send those out to you, and I will see you at upcoming meetups. Thank you all for attending. Bye-bye.